Hey there, financial enthusiasts and curious minds. Welcome back to our channel. Today, we're diving into the fascinating world of liquidity concepts, where we'll explore what liquidity is all about and why it's such a crucial aspect of the financial markets. So get ready to deep dive into the liquidity pool. Liquidity, my friends, is like the lifeblood of the financial markets. It refers to the ease and speed with which an asset can be bought or sold without causing a significant impact on its price. In simpler terms, it's all about how quickly you can convert an asset into cash without disrupting the market. You see, when an asset is highly liquid, it means there are plenty of buyers and sellers in the market ready to transact at any given time. This allows for seamless trading, ensuring that prices remain stable and fair. On the other hand, if an asset is illiquid, it means there are fewer market participants, making it more challenging to buy or sell without affecting the price. Liquidity is often measured by two key factors: depth and tightness. Depth refers to the volume of buyers and sellers in the market, while tightness reflects the bid-ask spread, which is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. Now let's explore why liquidity matters so much. Firstly, liquidity ensures market efficiency. When there's ample liquidity, buyers and sellers can find each other easily, leading to fair prices and preventing large price swings. This efficiency encourages investors and traders to participate in the market, driving economic growth. Secondly, liquidity reduces transaction costs. When an asset is liquid, bid-ask spreads tend to be smaller, meaning that the difference between buying and selling prices is narrow. This reduces the cost of trading, allowing investors to enter and exit positions with minimal impact on their returns. And thirdly, liquidity provides stability and resilience to the financial system. During times of market stress, having liquid assets allows investors to quickly convert them into cash, providing a cushion against losses or unexpected expenses. It also helps lenders and borrowers access funds when needed, keeping the wheels of the economy turning. But how is liquidity influenced, you might ask? Well, several factors can impact liquidity. Market depth can be influenced by the number of market participants, the trading volume, and the overall market sentiment. Tightness, on the other hand, can be influenced by factors such as transaction costs, market volatility, and the asset supply and demand dynamics. It's important to note that liquidity can vary across different markets and asset classes. For example, major currency pairs in the foreign exchange market tend to be highly liquid, while certain over-the-counter derivatives might have lower liquidity. Understanding the liquidity characteristics of different assets is crucial for investors and traders to make informed decisions. And there you have it, folks. A glimpse into the fascinating world of liquidity concepts. We've explored what liquidity means, why it's important, and how it influences the functioning of the financial markets. Remember, liquidity is the bloodstream that keeps the financial world alive and kicking. It ensures market efficiency, reduces transaction costs, and provides stability to the overall system. So, whether you're a seasoned investor or just starting on your financial journey, understanding liquidity is key to navigating the markets successfully. Stay tuned for more captivating financial insights and market knowledge right here on our channel. Until next time, keep diving into the world of finance, and may your liquidity flow smoothly. This is the Opportunity Specialist signing off. Happy exploring.